Welcome back to school. We held a session in Belleville yesterday, and it was actually held in a classroom at Loyalist College. And we just debated whether to put the seating around. Mrs. Keene, would you like to go to the principal's office? Everyone knows Jean Keene, or almost everyone. See, she's not even listening to me now, but that's okay. Right, Jean? Anyway, for nostalgia reasons, yesterday we left the room set up in classroom style, and it was kind of fun. I'd like to welcome Leave a Legacy session in many years. My name's Liz Dobbs-Jones, and I'm the chair of the Southeastern Ontario program of Leave a Legacy, which is a sub-program to the Canadian Association for Gift Planners, which is a self-regulated association across Canada with about 1,100 members who practice gift planning. It consists primarily of not-for-profit organizations and professional advisors who come together in a collaborative effort to encourage Canadians from all walks of life to consider an estate gift when they make their will and other estate plans. And so this program started in about 2001 in this region, has been on a bit of a hiatus, and last year a group of us took it upon ourselves to resurrect the program, and so maybe National Leave a Legacy Month, we thought it would be a good time for folks to come together and help raise that awareness around what is possible in terms of a legacy gift. I'd like to thank all of you for joining us today. Someone mentioned we should be holding this outside, and I couldn't agree more. I'd like to thank the panelists, who I'll introduce in just a moment, and our moderator. I'd like to thank St. Lawrence College for hosting the event today. And I'd also like to let you know if at any time you'd like to help yourself to refreshments. One of the most important things, washrooms are just beyond the student services sign and off to your right. And there are folks at the information desk if you need to find your way back, as I needed to earlier. So anyway, and the material on your tables, we have put an insert into 55 Plus magazine, and the agenda has been inserted right where that starts. So we'll be keeping to our agenda, and based on yesterday, there's going to be lots of time for questions. We will have an opportunity for informal dialogue over lunch, and I think you'll find that the morning goes fairly quickly. And your ticket for lunch is one thing. In order to get lunch, we ask you to fill out the feedback form. They're in the middle of the tables. You can just fill it out and leave it turned over on your table, but we do invite your comments in terms of how you found today. So we're going to be providing you with a very broad overview of what is possible. Our moderator today is William Petruck, I know him better as Bill, President and CEO of Funding Matters, which is a Toronto-based philanthropic advisory firm. Funding Matters has assisted in raising over $280 million for their clients. And not only is Funding Matters a consulting firm, but the creator of Gift Tabulator software, which illustrates for donors, advisors, and charities ideal giving scenarios. And I know we, at where I work, have invested in this software. And I find the best thing about it is it provides some numbers for people to at least start thinking, and then take that information to their advisors for further discussion. Our panel members, many of you may know today. To my immediate right is Jennifer Fisher, who is a partner with Wilkinson and Company accounting firm, and is very involved in the philanthropic community. So she'll be providing us with a voice from the accounting field. Next to her is Patrick Murphy, who's a partner with Secura Financial. And Patrick will be speaking to us today and answering questions in terms of financial planning perspective. Next to him is George Winter from the Winter Financial Group and Investors Group. And these folks are all partners with Leave a Legacy. And George will also be talking to you from, they'll both be addressing whether there's insurance opportunities or other financial planning opportunities. And to my far right is Mary Alice Thompson, who is a specialist in estate law with Cunningham, Swan, Hardy, Little, and Bonham locally, and is a certified specialist in estate law. And so what we're going to do for the next hour is Bill is going to moderate a discussion with the panelists and take them through some discussions. If you have questions, if you could just make a note on your notepads, and then we will have plenty of time for questions. At 11:30, we'll have a brief break. They're going to set up for lunch, and then we'll have some more time for interactive discussion. And again, do feel free if you need to get up and do anything to go ahead and do that. And so we believe that Leave a Legacy is really the power and the magic in Leave a Legacy is that it's a charity-neutral public awareness initiative. And so it's not about doing an infomercial for one cause or another, but rather to get you thinking about what cause is important to you and how do we all work together to make our community a stronger place to live. So I will now turn it over to Bill. I'm going to work the PowerPoint, which you don't have to worry about seeing the numbers too much. He will be speaking to them, and then we'll follow with questions. Thank you.
Good morning, everybody. How's everyone doing today on this beautiful sunny day? Well, it's probably a sunny day, but in the middle of winter, way back in the 1980s, that a fellow by the name of Sonny Bono decided to strap on his skis. And he was in Aspen, he was going down one of the runs, fresh snow, and I guess he looked up, and the first thing he saw was a tree. And when Sonny Bono hit the tree, his life ended. Surprisingly, Sonny Bono did not have a will. All the assets that he had, all the royalties from his songs, everything that he wanted to pass on to his family was in limbo. And one of the things that individuals look at doing in their lives is being able to create a legacy that will benefit their families, a legacy that ensures the work that they've done is recognized, and the legacy that they want to do for society is carried forward. And today, it's been that much more important, the work of Leave a Legacy, in terms of engaging people and to start thinking about things that are important to them. Their estates, their estate plans, their financial plans, and last but not least, is what they want to give back to society. From the charitable sector works really hard in terms of trying to build better hospitals, provide better education, have more books available in the library, provide opportunities for people to have access to social services. And it's through the efforts of individuals like yourselves today, this panel here, in terms of the advisors, that help move this forward. When you first came in, you were given a survey. Not the survey that you have to fill in to get your lunch. It's a multi-page survey. And the reason for this survey is to put you in a frame of mind. Because these are the questions, in one way or another, that individuals ask themselves at some point regarding their estates, their families, their community, themselves. It's what's in it in the donor's mind. It's what's in it in the client's mind. These questions, this typical questionnaire is a legacy questionnaire. It's something that we put together that allows the individual to, in many ways, self-identify. Because in many cases, the reasons why people don't do things is because their questions haven't been answered. And today, as yesterday in Belleville, I feel that a lot of questions were answered. Do you see, Lois, did you see that? A lot of people had an opportunity. What we're looking at is helping individuals seek the right advice, whether it's from legal, accounting, taxation, financial, philanthropic, community, whatever it is, to take you to that next step. Because, interestingly enough, adult Canadians right across the board, 78% give annually to charities. That's a great statistic. So $100 goes every year to their favorite cause. $200, $300, $500, $1,000, whatever it may be. They're giving on an annual basis. Of that 78%, if you can just picture, I'm going to draw an imaginary graph, okay? And 78% is up here, and we come down to 9%. And 9% are giving consideration to a legacy gift. So that 78% drops down to 9%. And by the time the individual's estate is settled, it's down to 4%. So all that effort, all the funding that you've provided to organizations over the years, it goes into this decay curve. And part of the process here is planning. It's estate planning, it's financial planning, and it's tied into philanthropic planning ties into it as well. So we've been able to bring this great panel together. And I'd like to start off with Mary Alice. What could Sonny Bono have done differently that would have maybe changed the fortunes for his family and made things a little easier in that transition?
Just take it over. I shout really well too. Well, I think that's an easy one. Thank you. You said you'd give me an easy question. He could have done a will, and it's such an easy thing to do, in fact. And if he put off doing a will because, as I recall, he had some family problems and he probably had a complex estate with a whole bunch of assets and so forth, he could have done a will that was still better than having no will, even if it wasn't perfect, and considered coming back at a later point when, you know, he'd clarified some of the things in his situation, but he'd still have been better off with some will than no will.
But in this case where, now the questions are going to get tougher.
In the case where I look at Canadians or North Americans as a whole, 60% of North Americans don't have a current will. And I find that when I meet with donors, and we do a lot of transformational giving, so we're working with individuals to help them realize the benefits of making a donation that has tax benefits to it. But the reality is the people that I'm talking to in the high net worth category, these individuals, that represents 40% of the Canadian population. 40% of Canadians who are classified as high net worth individuals don't have a current will. And I ask them, why don't you? And they say, because it costs too much. It costs too much to do that, or I haven't had the time. How can these individuals get over that fact, and what information could you provide people that will help them?
Well, can people hear me, first of all? Because as I say, I shout really well. Okay, I better have the mic back. It's the reason I became a lawyer. Better? Can you hear me now? Yes? No? Yes? Okay, good. All right, so cost of making a will. Well, first of all, in the realm of legal fees, wills are one of the few areas where lawyers tend to quote block fees. So many lawyers will give you a flat fee for straightforward wills and powers of attorney, kind of package of those services. And before you assume it's going to be too expensive, do what you would with anything else. Ask. I mean, that's the easy way. Some people even post their flat fees. However, don't assume that you're going to be the simple, straightforward case. I'm guessing Sonny Bono probably wasn't. So you may be into something a little more complex where the lawyer may charge hourly rates. You can still get an estimate of what that's going to be. Another way of looking at it, though, is because there's still people who have this sort of, the $100 will idea out there. You don't get bread for 5 cents anymore. You don't buy a house for $7,000 anymore. I don't know why you'd think you get a will for $100. But it still continues to be an area that is probably underpriced, because many lawyers look at it as an introduction and they expect if they do the will that they will end up doing the estate for you as well. So, if you want to bargain, doing wills tends to be one of the best areas to get a bargain from a lawyer.
Is it cheaper to draw up a will or settle a will, or settle an estate?
Drawing up the will is definitely cheaper. And I'll tell you the other thing that's a whole lot cheaper is any sort of a will, even the most expensive will you can imagine, is a drop in the bucket compared to estate litigation. So that's when you don't have a will, or you have a poorly prepared will, something you did on the napkin at the last minute because you didn't want to pay a lawyer for it, and it's not clear, and your warring beneficiaries have to get lawyered up and go off to court and fight for, half a year and a half, 5 years over what the will meant and what goes where, and, were you capable when you did it, and all those issues. That's what's really expensive. So, as an insurance, and I like to say, for me as a planner, it's all about keeping people out of court. And everyone I know figures they don't especially want their will contested in court. The way to do that is to do the planning of the will in advance.
Patrick wants to add to that as well.
I know there's donors in the room, but I know there's a lot of financial advisors in the room too, and the onus for financial advisors, we have the opportunity to sit in front of the clients and see where they're at and where they want to go. And one of the first questions we ask our clients is, do you have a will, when we gather facts and we gather information. The onus then becomes, to me, on us to make sure that when we're doing those reviews that we keep that information in front of them, because we all love to procrastinate. And what we find is that when we're getting together on an annual basis, we have clients that say, I know you told me to get a will, I finally got one. But maybe it took 2 years or 3 years or 4 years. It's so important to make sure that we keep talking to people. And even though I don't get paid to do wills, because that's usually what happens on the breakdown part, is we think, well, we don't get paid to do that, so why would we do that? It's doing the right job for the client. So it's so important for donors, especially in the room, all of us in the room, to have a will.
Well, yes, go ahead.
Sure.
What is, just if you wouldn't mind adding to that, is what are some of the recommendations that you would make to people in advance of this audience here? If they were going to walk away and tell their neighbor, tell their friend, tell a family member, what should they be walking away with in terms of that?
Well, I'm going to get to that, but I wanted just to do a small piece of background, which is what happens if you don't have a will? Because there's a certain amount of misinformation about that out there too. And I obviously believe it's better to have a will than not to have a will, and not having a will sometimes does result in litigation. But in Ontario, what happens if you don't have a will is, first of all, you have no executor. You have no person, no body to step in and handle your estate. It's a void, it's a vacuum. So somebody has actually got to go to court and get appointed before anything can happen. And that's a particular problem if you've got things like a working business or assets that need to be cared for in the interim. There's nobody authorized to do that. That's problem number one. Problem number two, if you have minor children, you have nobody appointed as the temporary guardian for those minor children. Again, we've got a vacuum and a void. Somebody's got to go to court, and that could create a serious crisis. Thirdly, your estate is going to be distributed according to the rules in the legislation, and there is absolutely no discretion for the judge or anybody else to change that. It is the way it is. It's the first $200,000 to the spouse, the remainder divided between spouse and children. If you don't have a spouse and you don't have children, it may go to grandchildren. No grandchildren to parents, no parents to siblings. No siblings, nieces and nephews, no nieces and nephews. That cousin that you always hated and the last thing in the world you'd have wanted to see was your estate going to that person. That's what's going to happen because that's what's in the rules. So what do you take away from this? Make everybody's life simpler. Do the planning. So what do you need to do the planning? You need to have a sense of what you own. And I do wills, but I work closely with accountants and I work closely with financial planning people because this is a team effort. It really is. One of the things I need to know when I'm sitting down with the client, so sometimes clients come in and they say, I want this to go to here, I want that to go there, end of story. And I go, whoa, wait a minute, we need to understand what you own because the will only controls certain assets. There are assets that pass outside of the will by way of beneficiary designation. So if you have registered plans, you have pensions, you have life insurance policies, all of those are controlled by the beneficiary designation. So in order to get the whole picture, you need to know what you own, you need to know who is designated as a beneficiary on those plans, and you need to know how you own things. So you need to know, for example, if you own a house, is it in your name alone? Is it in your name with your spouse? And if it's in your name with your spouse, is it joint tenancy or is it tenancy in common? And those are just really basic things that you need to know in order to do good planning in this area.
Very good. I think we've covered the will portion off, but
We haven't completely covered it off, because I've got a question here. Of this audience, who here has a current will? Pick up your hands. Oh, better than yesterday. Who has a charitable gift built into their estates? Okay.
So what we try to do is, when we think about charitable gifting, it has the benefit to society, but it also has the benefit to taxation. So that leads me to my next question. When we look and try to realize tax considerations and tax as it increases for individuals, for the government to not become a secondary beneficiary of your estate, what can an individual do as they sit down with their tax advisor, with their accountant, in terms of their annual review and as they look forward in their planning?
Okay. One of the things that I'm not sure that everyone is aware of, but when you die, all of your assets are deemed to have been disposed of at fair market value. So that's not a problem for things like principal residence or money that you have in the bank. But for your publicly traded shares, you're deemed to have disposed of them at fair market value. For your registered retirement income funds, which for some people can be quite a significant number, they're deemed to be totally taxable income. So Revenue Canada, right at the beginning, as soon as you file that individual tax return, is looking at taking approximately half of it, 46.4%, top tax bracket in Ontario. So any way you can avoid reporting something on your personal tax return or having something like a charitable donation deduction reported on your tax return, you're avoiding making payments to Revenue Canada, and instead the money stays in your estate. So one of the important things to look at is what, at the end of the day, are you willing to give to a charity and avoid giving to Revenue Canada? Because when it comes to dividing up your estate, you're looking at your named beneficiaries and Revenue Canada. They're right there at the table with all of your beneficiaries. So if you're able to avoid that by leaving a significant bequest to a charity or a life insurance to a charity, you're able to avoid paying significant dollars to Revenue Canada. So how that will come to pass is, just as we've been talking about a will and the importance of planning, is also planning for all of your assets. Because certain assets are taxable on disposition, on death, and certain are not. So, as has been discussed already, it's really important to work with the team. What are the assets that you have? How are they taxed? And what are the will's provisions that are spelled out in your will?
But when you're looking at having this conversation with your client, mind? How do you initiate the conversation? How do you sort of get them? Because this group is made up, it's a blend. We've got donors, we've got advisors, we've got charities here. And the charities, even from yesterday's conversation, were saying, how do I get my donor who's been giving me $500 every year, and they want to give us more, but I really can't. You know, we talk about sort of translating the benefits of these opportunities of them giving their appreciated assets to us to reduce their tax. But when it comes time to meet with my advisor, I really have a difficult time in explaining it. And I'm going to highlight a study that was done by Charles Schwab Foundation. So Schwab basically looked at the fact that 60% of their advisors have a difficult time in speaking to their clients about charitable gifting. And when they were asked why, one of the major factors that arose was the fact that they need more education in this area. And I can speak to that because I part-time teach at Schulich in the capstone program, and they focus on the area on charitable gifting is 10 pages of a 500-page text. And it really is not sort of a major area that's focused on. And when we come in, how can the charities and advisors such as yourself start to take that more of a holistic approach towards finding the right solutions for the individuals who themselves are trying to do well because it's good for them? One just...
Sure. Maybe I can start with
and then go
how
for the
it
panelists.
Sure. With my mix of clients, I have small business owners, and so more than once during the year, I'd be meeting with them. We'd be going through their financial statements, and one of the questions is, you know, what's the situation with your current will? As assets start to appreciate, it's time to do an estate plan. What is the tax consequences if you're hit with a Mack truck today? What is the consequences to how much money is left in the estate, actual cash, and how much are assets that would have to be liquidated? And so that opens the doors to some pretty, in some cases, some pretty startling numbers, because individuals have worked very, very